Going live. Hello? Mic check, mic check. Doing a little mic check, mic check. All right. Cool. We are going to get going live here. And get this party started. Let's put this over here. All right, fix my hair here. Don't want to look like a dweeb. All right, we'll go ahead and get started then. And we'll pop it up here. I was so worried about my hair. All right, so flip our camera here. Mirror your video. All right, so we should be looking good here. Let's back you up a little bit so you can see the whole board that I'm working with today. All right, so again, my name is Drew Smith. I'm a licensed loan officer. We got all my compliance information up here, NMLS number 2113580. If you've got any questions today, please feel free to go ahead and drop them in the chat. I will answer them as I can. Today, I want to give you 5 tips to qualify for a home loan. Now, everybody's starting in different places, so I truly understand that. I always like to meet borrowers where you are. However, this is what I would be doing if I was thinking about qualifying for a home loan today. These are the 5 things that I would be looking into. So first things first, let's take a look at credit here. So when it comes to credit, you want to know your position. So the first thing that you want to do is pull your credit report. Okay, so go ahead and pull a report. Now, this is something that you can actually do fairly easy. You can set it up with each of the credit bureaus. So there's 3 credit bureaus, Equifax, Experian, and TransUnion. You can set up accounts with each one individually. And then you can also go to, I believe it's freeannualcreditreport.com, and you can actually pull a credit report. So you can actually know what's going on. What's going on here? All right. So first things first, you want to pull a credit report. You want to know what's going on. If you know what's going on, right? Sorry, I keep getting distracted here. So if you know what's going on with your credit report, that is going to put you in a better position to leverage your position, right? So you know what's going on there. So you need to know your history. When you pull that credit report, it goes back 7 to 10 years. So knowing your credit report and your history will make you a more informed borrower, because there's a few guidelines when it comes to qualifying for a home loan that you need to be aware of. Late payments, derogatory accounts, charge-offs, collections, those will show on your credit report. And depending on when those things originated, you might have an issue qualifying for your home loan. So pulling that credit report will put you a little bit ahead of the game, because you'll know exactly what it looks like and what the lender is going to see when they take a look at that account. Knowing your credit report and your history will help you, because you can actually have an idea of what's going on before you actually speak with the lender. And if there's anything on that report, you can go ahead and dispute it. We're human. There are mistakes, accidents, things happen. A lot of times I'm speaking with borrowers, there's something on that credit report that's inaccurate or fraudulent, and it's no fault of their own. So can we actually get that removed? That's something that you want to know ahead of time looking at your individual credit report. Now, another thing, like I mentioned, you can sign an account with each of the bureaus, right? So you can create an account with each one. And then you can get alerts. So if anything happens to your report, right? So if there's a new account opened that you didn't open, it's going to give you an alert. They love sending you emails, and once you create that account, you will get regular emails from them. And then anytime you get your credit pulled, it will send you an alert as well. So it keeps you informed as to what is going on with your account all of the time. So you're just plugged in, and you can always stay on top of what's on there. The next is to keep your records. So a lot of times what's going to happen is something is going to show up on your account and you might not know what it is. In that case, if you have records to go back to refer back to, you can dispute things that happened. Sometimes a reporting agency might get it wrong. They might say, hey, this borrower was late on their payment in May, when in fact you weren't. If you keep your bank records showing that you paid that credit card, that car loan, if you're showing that on your end you actually paid for it on time, you could do one of two things. You can take it to the bureau, of course, and you can say, hey, this is inaccurate. Can they remove it? You can take it to the creditor and say, hey, you need to remove this off of my credit report. I paid you on time. Here's my receipt from my bank account. Get that off of my account because I actually paid it on time. So that's what you need to know about your credit when you are looking to qualify for a home loan. Again, pull a report, know your history, know your situation, look at it, go over it, make sure everything on there is indeed accurate and there's no mistakes on there. And then set up your alerts and get hooked up with the 3 credit bureaus, again, Equifax, Experian, and TransUnion, so that you have a good idea of what's going on and you're always on top of your own credit. The next thing that we're looking at when we are qualifying for a home loan is work history. So, history. So one thing when you're looking at qualifying for a home loan is going to be your income, right? That's one thing that a lender really wants to make sure that you have income to pay for the mortgage, right? How are we going to pay for this mortgage? So that's a huge thing that the lender's looking at, work history. Now, in general, you need 2 years worth of work history. So, typically the same industry, okay? Now, it doesn't have to be at the same employer or the same job or the same city or the same state, but it typically needs to be in the same industry. Now, it can be a lateral move. It could be a promotion within the same industry. But if you're going from maybe being a restaurant manager to now being a CPA or a loan officer like myself, something like that, right? They're going to look at that and they're going to have some questions about it. You transferred from one industry to a completely different industry. We want to see some stability within the same industry for qualifying income. Now, one cool thing about the work history is that you can use schooling for work history. So this 2 years can be made up of a year worth of schooling to going to school to become a nurse, and then 1 year on the job as a nurse. That creates your 2 years of work history. It can also be a trade school. If you went to a trade school to become an electrician, that took 6 months. Now you've been on the job for 1.5 years. You can mix and match like that to create your work history. So again, if you're just joining, my name is Drew Smith. I'm a licensed loan officer. I'm going over my 5 tips to qualify for a home loan, what I would be doing right now if I was looking to qualify for a home loan. So there's a little bit more about work history. Then we also have self-employed borrowers. If you are self-employed, you need to have 2 years, again, of owning that business. You need to have owned that business for 2 years and filed 2 years of tax returns. And what we are going to do is take the average. We're going to take the average of the income that you made over the last 2 years. So that's really important for self-employed borrowers because we have these little things called write-offs. So if you had 1 year where you wrote off a lot and then another year where you didn't write off so much, we're going to combine those 2 years, average it over the last 2 years, and that's going to be your income when we're looking at self-employed borrowers. I have gotten in trouble a couple of times with some self-employed situations where we're actually writing off more and we're showing a loss for 2 years. And in that case, depending on the loan program, we actually have to write that loss as a liability. So what that looks like is anything else. So you've got your credit cards, your car loans, your student loans, any kind of debt that you pay on a monthly basis. Now we've added in the business because you're actually losing money on that business. So we have to add it in as a liability. So that's something to be very aware of as a self-employed borrower. Now, I'm not giving out legal advice or accounting advice, but just know that when you're going into a loan, knowing this is going to help you if you are self-employed. You want to show as much income as possible, of course, within all the laws and everything, keeping everything legal. But just know that anything that you write off as a loss may count against you when you are qualifying for a home loan. So that comes back to knowing your guidelines, okay? So that's a little bit there about work history. Now let's talk about rental history. Okay. So, it's not everybody's situation, but typically we are going to see a lot of people renting before we purchase. We are looking at 2 years of rental history. And what we're looking at with rental history is good performance. So it's going to make your position look a lot better if you've never had any issues with your rental. Now, there's a couple different ways that people rent. Of course, you can go through a mortgage company and do an apartment complex or something, right? So you have an apartment. You can rent a home. And this could be through a management company, or it could be an individual. When we are looking at your rental history, we do what's called a VOR. That's your verification of rent, where we are actually going to reach out to the current landlord, whoever is leasing you that property. And we're going to verify that the borrower has been making their payments for the last 2 years, and we're going to verify the rent. We are looking for on-time payments. Late payments could be an issue. So when you are renting, make sure that you're always perfect on time with your rent. Whether you're doing it with an apartment, whether you're renting somebody's home, whether it's through a property management company or an individual, you want to always be on time with that. And then you also want to keep your own records, okay? So if you can always show through bank statements, okay, that you have paid your rent on time. If there ever is an issue, let's say we did that verification of rent and the landlord said, hey, they were late a few times. You can then dispute that, pull up your own bank records, and show that indeed you were actually on time. Now, we do have situations sometimes where somebody is renting from family. You have a handshake agreement. You've agreed to pay mom, dad, brother, sister, aunt, uncle, whoever it is. You're going to pay them an X amount of dollars per month to rent a house that they own. In that case, there might not be a lease agreement, but we can still do a VOR, that's a verification of rent, through bank statements. Now, depending on the type of loan and whether we're doing a manual underwrite or if we have AUS approval, we might need to verify 24 months worth of rental history. So if we run into that situation, we're going to need to have bank statements. We're going to have to prove that you indeed actually paid that rent for the last 24 months. If you just did cash, that's going to be an issue. We're not going to be able to verify, that you paid your rent for the last 2 years if you can't prove it. If you're just saying, well, I paid cash, that's going to be a problem. You have to be able to source and verify it. So I always recommend paying your rent through some type of payment platform, online platform, whether that's your bank with a direct payment, because you can see that on the bank statements that you transferred X amount of money to, and depending on the bank, it might even show the name of that person, or at least shows the account. It's showing that it was paid every month. Zelle transfers, any type of online program where you're sending money to somebody else, but you can track it. So keep good records if you're in that situation and you're paying your rent like that. And then back to it, always pay everything on time. Keep your rental history up to date. Always make those payments on time. And that is going to help you with your home loan application and process. All right, so the next thing is reserves, okay? And this is also savings. This is just money, 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 all right? Do you have money that you can use towards this transaction? Borrowers that have money in the bank, whether that's cash, checks, checking account, savings, if you've got retirement accounts, 401ks, IRAs, that is going to strengthen your position. Depending on how much you have, you can show to an underwriter, to a potential lender, that you have plenty of money. If you were to lose your job, you could pay your mortgage for the next 3 months without worrying about it because you have enough money saved up for it. Another thing that you're going to need reserves for are down payment and closing costs. Now, there are loan programs out there that require no down payment, but that doesn't mean that there's not going to be closing costs. So the down payment is just for the specific loan program. So if you're going conventional, you're going to need 5% down. There are some programs out there through Fannie Mae and Freddie Mac that you can do 3% down. It depends on the area median income, different factors like that, but at least 3% down for a conventional loan. For FHA, you're going to need 3.5% down. In some cases, you might need 10% down, depending on credit score. Now, there are programs out there, FHA especially for first-time home buyers, where they help you with that down payment. Also, a little trick on that, or a tip, it's not a trick. If you have not owned a home in the last 3 years, you're considered a first-time home buyer. And then if you're going USDA, actually, no down payment required for USDA, but the property in question, there are some guidelines on that. It has to be in a rural area. It can't be in a big metropolitan city. So depending on the location, you may or may not qualify for USDA. You can look up on the USDA website whether a property is eligible or not. And then VA, you can do 100% financing, no down payment required for that either. Welcome, everybody. If you got any questions, pop them in the chat, and I will answer as I can. All right, here's one from Dawn. Can you use your disability compensation to buy a rental property? Yes, you can. You cannot use the VA loan for that, though, because the VA loan has to be on a primary residence only. You cannot buy an investment property using your VA benefit. Now, what you can do is buy a primary residence, live in it for a couple of years, move out of it, and then keep it as a rental. But if your initial intention is to buy a rental property using your VA benefit, you can't do that. But yes, your VA disability income is non-taxable income. You can use it for FHA, conventional. You can use it as qualifying income. So that's a little bit about reserves and savings. If you have some money in the bank, it's going to strengthen your position, and you will have to cover some closing costs. Now, what are closing costs? These are costs associated with the loan outside of the down payment. So when you're purchasing a home, you're going to have your escrow account. Now, escrow sounds fancy. All it is, it's a bank account set up with your lender. You can think of it as a bank account set up with your lender that houses and holds your property taxes and your homeowner's insurance until it's due, until you have to pay those items. So what they do is when you purchase the home at consummation, they set up a different account every month as part of your monthly mortgage payment. They take a portion of it, put it in that account, And then depending on what state you're in, wherever you are around the nation, whenever your property taxes are due, they take them out and they pay them on your behalf, essentially. So that's all the escrow account is. But at the time you close, you're going to have 12 months of homeowners insurance at the time you close. That's 12 months. So that's your whole premium. So it's not like car insurance where you kind of pay month to month and you do 6-month chunks. Homeowners insurance is due all up front, all at once. And that can be a couple $1,000s depending on the property and location. So that's part of closing costs. Your taxes, your property taxes are rolled up in there too. Now, if you're waived from a portion of property taxes, it depends on where you are in the state and the nation. You might be able to get that applied at the time of buying the house. Otherwise, what you have to do is go to the county and you have to submit your application for a waiver of property taxes after the fact. So you might have already had to move in, even if you are waived and you have a homestead exemption from property taxes. That still doesn't mean that you might not have to pay them up front and then get reimbursed or have them taken off later. Okay. So that's something that is part of your closing costs. Then you also have third-party fees. Okay. So these are things like title and then state. So you may have some recording fees, and then for the title work, you're going to have people working on this. They're going to be doing title search. You're going to have an escrow officer that's going to get things set up. When you go to the closing, you'll have the escrow officer there, sometimes your realtor, your loan officer, and those are going to have to be paid, right? So you've got different people working on these items that need to be paid for their service, right? Throughout the loan, you can have 24 people working on the loan, really just depending on how it's all set up from different transaction coordinators, brokers, loan officers, loan officer assistants. There's lots of people working on these loans on your behalf, and those fees need to be paid, and they can add up to thousands of dollars. Now, the cool thing is that some of these closing costs in this market that we are in here in early 2023, I guess we're getting close to mid 2023 actually at this point, we are getting seller concessions to help cover some of those costs, but closing costs are paid in addition to the down payment. So there are some costs associated with the loan. And then you'll also have your earnest money that you put down on the home. You can think of it as promissory money. When you're purchasing a home, they typically ask for 1% of the purchase price. So if you're looking at a $300,000 purchase, they're going to ask for a $3,000 earnest money check. Now that does go towards your closing costs, but it is money that you're going to have to show the seller of the home that you're interested and serious about purchasing that property. And then, where did I put my eraser here? Here we go. The last thing that we're going to be looking at are your options. You should know your options and what is available to you and compare those to see which one might be best for you. So of course you've got your traditional lending, right? And we can do FHA, we can do VA, we do conventional, we do USDA. So knowing your different options on your traditional lending will help you because each one of them are going to have different down payment requirements. Each of them are going to have different DTI or debt to income ratios. DTI is basically your buying power. How much debt can you have in relation to your income? So again, I see a lot of people popping in. If you've got any questions, please feel free to drop them in the chat. We're talking home loans, mortgages, any questions that you have. I'm a licensed loan officer. I can answer some questions for you as long as they're mortgage related. So knowing your different lending options, what you can and can't do with them, and what the requirements would be for you as far as your obligations on cash, cost, and things like that, right? Then you've got your banks. So local banks are what you can think of. A lot of them are portfolio lenders. Now, what this means is what they sell or what they lend, they keep. They don't sell it on the market. Lending, when you're doing a conventional mortgage that's backed by Freddie, Fannie, the VA, or USDA, they'll sell those. They're pieces of paper, they're notes. And then they're just like investments, and they can get passed around lender to lender and things like that. With banks, they can technically do the same thing, but traditionally, depending on the bank, of course, your larger banks are going to go outside of that, but a smaller local bank is probably going to keep it. And they might do what's called an ARM, an adjustable rate mortgage. Now, ARMs aren't good. They're not bad. They're a product. They're an option that you can utilize to your advantage. My wife and I currently have an ARM on our home, and we did that because we know we're going to refinance in the next couple of years. We purchased at this time when the interest rates are high. They're the highest that they've been in years. And we think the interest rates will come down. We don't have a crystal ball. They might not come down. So either way, we got an ARM. We got what's called a 7-1. So what that means is that for the first 7 years, it's a fixed rate, meaning that it is not going to change for 7 years. But after that 7 years, on year 8, it is going to adjust to the current market. And then every year after that, it will adjust. So they also have 5-1 ARMs and really any kind of combination that you can think of. But 7-1 and 5-1 were our options. So again, that's 7 years fixed. Every year after that, it adjusts to the current market. And then we've got 5-1, which is 5 years fixed, and every year after it adjusts to the current market. So they both had different costs associated with them. However, at that time, they were cheaper than doing a conventional type mortgage because of the cost associated with it. That's why we went with that one, because we know we're going to refinance in the future. That goes back to knowing your options. We wanted to know our options, and based on our circumstance, that dictated the product that we ended up using because we knew what we wanted to do down the future. Now, there's a couple other reasons you might use an adjustable rate mortgage. If you're military, right, you might get PCS'd. You might get a permanent change of duty station whenever. So maybe you don't want to be tied down to a specific area, but you at least want to lock in your mortgage. So you might be thinking about doing an ARM. You could be any other kind of contract work that gets you shipped around the nation. So you might be thinking about switching locations. So knowing your options and why you might choose those different options is good. And then lastly, you have, it kind of falls in your traditional lending, but that is brokers. Brokers have access to a variety of products. So they have tons of different lenders and banks that they work with, and they would be able to give you a large variety of options. Now, there are other types of loans out there that don't fall under the QM products, right? So they're not qualified mortgages. They could be non-QM. And that means that they're outside of kind of your conforming regulations. And they do lots of interesting things like bank statement loans, right? They look at your bank statements for your income. So just knowing your different options, now that's not something that I specialize in. I do have access to it, however. So those are good to know about your options. So let's go ahead and follow up here and talk more about what I would recommend. These are my 5 tips to looking at getting qualified for a home loan. Again, my name is Drew Smith. I'm a licensed loan officer. Military Home Spot Lending, NMLS number 2113580. All of my information is on my page. If you've got any questions about lending, mortgages, VA loans, FHA loans, USDA, pop them in the chat. I will answer any questions that I can as long as they are mortgage related. But now let's give you my 5 tips when you're looking at getting qualified for a home loan. So the first tip is credit. Now, what do I mean about credit? You should have a good score? No, that's not what I'm saying. I'm saying that you should know your credit. You should have an idea of what's going on with your credit. So I recommend pulling a report. Now, you can do this yourself. You can go to freeannualcreditreport.com and you can actually pull your own report and look at it yourself. If I was looking at buying a home right now, I would want to know exactly what's on my report. If there's any derogatory items on there, what it's showing, if it's showing any late payments, anything like that. I want to know before anybody else pulls my credit so that I can head them off with any questions that they might have, and also do any research on that if I find any discrepancies in that report. So that's the first thing that I always recommend. Know your situation. Now, I know that's not always easy. Everybody comes from different walks in life. If that's something that might be a challenge for you, please feel free to reach out to me. I'm happy to help. But pulling your credit report and knowing your situation is absolutely paramount when it comes to looking to qualify for a home loan. The next thing is to dispute anything, all right? If there is something on your report that is either inaccurate, fraudulent, false, wrong, dispute it. You need to get some type of something on the record out there as soon as possible that you don't agree with that account and you think it's wrong, to work towards a resolution. Sometimes these credit issues don't always happen super quickly, so you need as much time as possible to dispute anything on there. The next thing I recommend is to set up alerts. You can create an account with each of the 3 bureaus. That is Equifax, Experian, TransUnion, and you can actually set up for alerts within there. You can get email alerts, text alerts. I think you can do whatever you want there, but you should always have some type of connection with your credit report so that you are alerted when anything happens on there, right? So there's lots of fraud nowadays. You want to be the first person to know when something happens there. I have spoken with borrowers about accounts on their credit report that they have no idea what they are. Now, sometimes it's because it gets confusing and they get sold, like collections and things like that. So that makes sense, right? So, hey, Evan, what's going on? My nephew, Evan, is joining us here. So thanks for joining. We're talking about mortgages here and my 5 tips when you're looking at qualifying for a home loan. So stay awake. Any tips for getting my first credit card? So yeah, let me get to that in a second. For first card, but let me just finish my thought here on setting up alerts, right? With all the fraud that's going on, you want to be the first one that's alerted when a creditor pulls your credit so that you can dispute that immediately and avoid that fraud if something is coming up. So let's put a pin in this for now, and I'll get back to your credit in a second. So any tips for your first credit card? So first thing I would do is go to my local bank and see what they have to offer as far as any type of local card with my local bank. Then you can look into what's called a secured credit card. So this goes back to if you are first starting out, you don't have any credit, there's nothing for them to look at. When a lender is lending money to a borrower, they want to make sure that they're a good credit risk, and this counts for credit cards as well. So if they pull your credit and they don't see anything on there, they might decline you for a credit card just based on past history. There's nothing for us to make this judgment on. Unfortunately, we require a minimum credit score for you to get a credit card with us, but you don't even have a card yet, right? You haven't even established anything. So there's a couple things you can do. You can get what's called a secured credit card. This is where you're actually putting up the money first. So you have to look around a little bit for this, but they're out there. Start with your local bank. You give them the money first to start the account. Then that sets your limit. Then after that, you can just borrow money on it like a regular credit card on a revolving basis. So look into a secured credit card to start your very first card. And then you can also do what's called an authorized user. So if you have, mom, dad, uncle, aunt, somebody that trusts you and that you trust, they could add you as an authorized user, and that will start building your score to where you could actually step off and maybe start your own credit card after that. So hopefully that helps. If you got more questions, please feel free to reach out to me. Again, that's setting up your first credit card. So good luck. Hope it works out for you. So let's see here, credit, and then keep records. All right, and I'm not talking about music and old-timey music and records and stuff. I'm talking about keep your bank statements, keep your receipts, anything that you get from a creditor, keep those. Now, again, all of these things stay on your credit for at least 7 years, sometimes up to 10 years, depending on the type of account. So keep records. If there's ever any kind of discrepancy on your credit reports and with your records, you can dispute it. You can show that to the creditor and say, hey, look, you're showing that I was late here, but I've paid my credit card every month for the last 5 million years. I paid it on time, and I have the bank statement here showing money going out of my account into your account. Remove that from my report, okay? Now, if there's ever an issue where they refuse to do that, or the credit company's being a pain in the butt and they won't do that, you still have your records, so you can actually show to a lender and prove that late payment is indeed false. So that's something really cool as well. You can always dispute that on the back end. Say, hey, I'm dealing with the creditor right now. They're being really difficult. They're saying that I was late on it. I wasn't late. I've got records. Here's my records. What do you think? We've actually been able to get around that in a couple of loans that I've worked on because my borrowers had really good records. They could show that they weren't actually late. They have records to prove it. So keep your records. That is really going to help you in the future. Put it on a flash drive, put it in a drawer anytime, every month, at the end of the month, however you want to do it. Just keep those records so you can easily refer back to them. And really, you just want the last 2 years and at least the last 12 months. So when it comes to qualifying for a home loan, we're really looking at the last 2 years very, very frequently. So, all right, you're welcome. I'm glad that was helpful. Now, the next thing that we are going to be looking at is work history. Okay. Work history. 2 years. 2 years is what we're going to want when qualifying for a home loan. 2 years worth of work history. So we want to show to the underwriters that you've been working for the last 2 years and that it's been in the same industry, okay? So this is going to show stability and qualifications. So 2 years, work history in the same industry. Now, it doesn't have to be at the same exact job or at the same location. You can switch jobs from place to place. You could be a nurse at this hospital, and then you could be a nurse at this hospital and be a nurse at that hospital. You don't want to jump around too much. You could be labeled what's called a job hopper, because that could be an issue if you can't hold a stable job for a long period of time. But if you've had 2 or 3 jobs over the last couple of years, that's not going to be an issue, especially if it's been in the same industry. Now, you might have to explain it with a letter of explanation and say, hey, I moved out of state, so I got a new job. Or, this hospital offered me more money, so I went to the new job that offered me more money. That's a no-brainer, right? I'm not going to pass up the job. It's offering me better hours, better pay, better benefits. So that's easy to explain. But we're looking for the last 2 years in the same industry. Now, schooling can count as work history. So if you went to school to be an electrician, that took 6 months, and now you've been on the job as an electrician for a year and a half, then there you go. You've got your 2 years worth of work history. So it doesn't necessarily have to be at the same job with the same employer, but you're looking at the same industry. Now you can get promotions, especially if you've been at the same job, but throughout that job, you've kind of bounced, done different jobs at the same employer. That's going to look good as well, especially if you are getting promoted, right? So that's your work history. All of the guidelines, all of the loan programs, we want 2 years worth of work history. Any gaps in employment need to be explained, especially if they've been long gaps of employment. So if I was qualifying or looking to qualify for a new home and I was thinking about switching jobs, I might hold off for a little bit, especially when it comes to the different types of jobs or ways that people are paid. So we've got essentially 2 ways that people work. They are W-2 employees, or you are self-employed. Those are basically, when you break it down, the 2 types of ways that people are paid. W-2, this is a lot easier to start counting immediately. Self-employed, you actually need 2 full years of owning and operating that business and filing taxes for it before we can qualify you with it. When you are self-employed, taxes get a little bit more complicated. There's different write-offs. We want to make sure that you're also able to sustain business and keep it going. And then we average it over the last 2 years that you can show us tax returns for that. And then we also might need a P&L or a profit and loss statement to show what we've got going on there. W-2 income is a little bit more straightforward. However, there's a couple things that we need to be aware of, and that is bonuses and commission or any non-variable income. A lot of people get not necessarily kickbacks, but they get per diem. So you might make irregular income. Anything that you're looking to use for that might be an issue, and we need 2 years worth of it. So if you get bonuses as a big part of your income or commission as a big part of your income, we're going to need 2 years of that, even if you're W-2. But if you make a base salary, we can count that pretty much immediately on your W-2. So hopefully that answers some of those questions. Another important thing with self-employment is if any tax write-offs you have, those could be counted against you in your liabilities. If you write off a large amount of your business, whether that's a company car or a building or a location or something, large write-offs like that carry over year to year might actually count against you. I have been in a situation where we've actually had negative income from a business and had to count that in a liability. Okay, so just think about that. Next, we're going to move on to rental history. Again, my name is Drew Smith. I'm a licensed loan officer. I work at Military Home Spot Lending. My NMLS number is 211-3580. If you have any questions, go ahead and pop them in the comments, and I will answer them. So, as long as they're mortgage related, rental history. We want 2 years worth of rental history. This is something that we do, what's called a VOR. So when we are qualifying a borrower for a home loan, we will reach out to the employer, the landlord. So we've got a verification of rent is what VOR stands for. We'll reach out to the landlord. We will verify that the borrower has been paying their lease agreement or their rental on time for at least the last year, possibly the last 2 years, depending on the situation and what type of loan that we're doing. So you always want to make sure that you're paying everything on time. And again, you want to keep your records. Okay. Now we are sometimes in the situation where we have a rent-free situation where you are, hundreds of different situations, right? But just for instance, you have a soldier who was in the military, they separated from service, now they're living with mom and dad until they can transition and find a place to live now, right? So they're getting back on their feet, getting everything back in order. In that case, you could do what's called a rent-free letter, where you are stating to the underwriter and the lender that I've been living with mom and dad for the last couple of years for free. And then your mom and dad would also submit a letter saying that, yes, indeed, they have been living here rent-free for the last couple of years. So if you don't have rental history, we could always do that. You always want to keep your records, though, especially if you're doing any type of handshake agreement or paying cash. This gets us in trouble a lot because we can't verify rent. You're just saying, yeah, I pay $700 a month in rent. I've been doing that for 23,000 years, but I don't have any records and I can't prove it. So you always want to keep records of that as well so that you can show that if anything, you have a verification of rent. And in some cases, we're going to need 24 months on a manual underwrite for a VA loan. We could be asking for 20 months, 2 years worth of verification of rent. And if we don't have it, that could trip us up. So if you have good records and you can show that, that will be easy. What are records for that? Bank statements. So if every month you make a transfer from your bank account to another bank account of X amount of dollars, and you did that every month on the first, you could actually show your verification of rent that way. So keep good records, keep your bank statements. You transfer money. There's dozens of different ways that people pay their rent now. We've had Zelle transfers. And again, that's bank statements. And we've showed that over the last 12 months that they've been paying their mortgage or their rent with those Zelle transfers. We can see it on the bank statements. Every month on or about the second of the month, we see that money transfer over there. So keep records of your rental history. It's really one of the more important things when we're looking at qualifying for a home loan, because it's more comparable to what you're going to be paying, and that is your mortgage. So having good history and good records of your rent and what you've been paying, always keep your records. So I've said that a couple of times now. Keep your records. It's always a good thing to have those if you need to use them in the future. Now we have reserves. Number 4. Again, these are my 5 tips when you are looking to qualify for a home loan. If you have any mortgage related questions, please feel free to drop them in the comments and I will answer them to the best of my ability. So reserves and savings. While some loan programs you can do 100% financing, that doesn't mean that there's no cost to it. And this is some of the disconnect here that we have a lot of times when I'm talking to borrowers, especially with the VA loan. So you're going to have something called closing costs, okay? And this is outside of any down payment requirement. So if you're looking at a conventional loan, you're going to need 5% down. Now, there are some conventional loan products where you only need 3% down, but typically you're looking at 5% down. Then if you're going FHA, you need 3.5% down. Now, there are some first-time buyer programs out there which help you cover those closing costs. USDA, you can actually do 100% financing, but there's still going to be closing costs. And then conventional. I think I covered all of them, right? FHA, conventional, USDA, and VA. So closing costs are outside of the down payment, and these are things like your escrow account. Your escrow account is your homeowner's insurance, that's HOI homeowner's insurance, and your property taxes. These need to be paid at consummation or at the time you close on the loan. Your homeowner's insurance is going to be 12 months for that initial policy. Then it's going to be 2 months of reserve. So we're looking at 14 total months worth of homeowner's insurance. Property taxes, this depends on when you buy the home and where you buy the home. Property taxes are due and it varies county to county, so it's very state and property specific, but that could be a couple thousands of dollars right there. Property taxes, some of the highest are in Texas actually, and I've seen some of the property taxes, and that's like half a mortgage sometimes in other states, just the property taxes. And again, depending on when you close on the home, you could have 8 months worth of property taxes due, plus 14 months worth of homeowner's insurance. See how this all keeps adding up a little bit? So you need to have some savings, some reserves to be able to pay for those costs. That's a really sad arrow there. I promise you it's an arrow though. Then you're also going to have third-party fees. This is going to be like title and your state recording fees, all right? And your government-like fees. So your title, when you start purchasing a house, there's a third party involved and everything goes to the title company. They're going to have an escrow officer working on this. For the lender, we're going to have a processor. We're going to have an underwriter working on it, right? So there could be up to, 24 people working on your loan at any given time, and those have a cost associated with them, right? We want to pay these people for their work. All that's part of closing costs. So you've got title fees, you've got state recording fees, you've got lender fees. All this to say that all this can add up and it can cost, right, some money. And these are your closing costs, which are paid outside of any down payment requirement, depending on the loan product. They can add up very quickly once you start putting in those property taxes, homeowners insurance, transfer taxes in some states can start to get a little bit pricey. So if you have some money to cover that, that will put you in a good position. Now, we are in a market right now. We're getting closer. I was saying early 2023, but actually now we're in May, so we're actually closer to mid-2023. We have been able to get some of those closing costs covered by the seller in what's called seller concessions. Now, it depends on the market, wherever you are around the nation, but that's where when you put in your offer to buy the home, you're asking the seller of the home to give you seller concessions or seller credit, and this helps you pay for some of those closing costs. But at the very least, you're probably going to have to at least put up your earnest money and pay for some of those third-party fees. And I didn't even add in some of the personal items that you're going to want to get, like a home inspection. We don't look at the home inspection. It's not always required by the lender, but that could be a couple $100 to have somebody come in the house, do your home inspection. So that's a little bit more about reserves and savings. Anything that you can have will put you in a better position. So if you can save up a couple $1,000s, that will really help you when you are looking to purchase a home. And then the last thing I always recommend, or what I would be doing if I was looking at qualifying for a home loan, is I would be asking a lot of questions. I would be talking to me. I would send me a message. I would talk to your local bank. I would talk to friends and family and ask if they have any recommendations, but know your different options, all right? So we got banks, we got lenders, and we've got brokers are some of the main ones out there, okay? And there's a little bit of crossover here. So your bank, hopefully that's pretty self-explanatory. Go to your local bank and ask them what their requirements are. Do they have a loan officer that you can speak with to go over some of your different options? Now, banks are, not all of them, but what some of them are considered are portfolio lenders. Okay, and so with a bank, sometimes it can be a little bit harder to qualify because they have higher risk tolerance. So they are keeping everything on their books or in their portfolio. So they don't sell these loans on the back end or in the open market. Your QM, your qualified mortgages, your conventional mortgages, they're sold on the open market. Now, these ones at your bank, they're kept in-house, so they have a little bit higher requirements for it. Now, they all have to adhere to some kind of the governing organization as far as, the ECOA, the Equal Credit Opportunity Lending, all of those kind of federal laws out there. But as far as like your down payment, your loan to value, they can have their own requirements for those, especially credit score as well. But talk to your local bank, see what they have to offer and see what their requirements are, knowing some of your options there. Then go out to different lenders. So I'm kind of a combination between a lender and a broker. So we're a direct lender. At Military Home Spot Lending, we can lend the money directly, but then we also have some other products that we can kind of broker it out to depending on the situation. So I'm a little bit there in between. And then brokers have access to the most products. They can pretty much shop anywhere they want. They can get signed up with 20 different lenders and investors to have access to basically every product out there. Then there's other parts of lending that we don't even talk about that are outside of my expertise. It's called hard money. It's basically just individual investors out there putting money out on the streets. They have their own requirements for that as well. So learn about your different options and what the individual requirements are for them and see which one might fit you and your specific situation. It's what I always recommend for borrowers. Basically, education is key in this industry. Knowing your products, knowing what you can and can't do really lets you know where you kind of should be directed depending on the situation. So for us, my wife and I, we looked into it and we got a ARM. So based on the current market, we bought here not too long ago when rates are really at the highest that they've been in years. So we decided to go with an ARM. That's an adjustable rate mortgage. And the reason we did that goes back to when I was talking about the cost, knowing the different cost between the items or the products. The 7-1 ARM is the one that we ended up going with because it was cheaper to originate at that time. And we did that because we know we're going to refinance in the next couple of years. So we wanted the least amount of cost up front because we know in 3-4 years, we're hoping that rates go down. We think that rates are going to go down. Of course, we don't have a crystal ball, so we don't know for sure. But based on our history and what we think the future is going to do, we decided to go with an adjustable rate mortgage because we plan on refinancing anyways. So we wanted to lower the initial cost because we know when we refinance, there's going to be more costs, right? So the least amount of upfront costs that we could go with, and that's why we went with the adjustable rate mortgage. We went to a local bank, and that's what they were offering at that time. Now, not all lenders are going to offer ARMs. So you might have to shop around to see who's going to offer the different product that you are specifically looking for. And that's really it as far as the big tips that I have. These are the 5 tips that I would go over. You know, if I was looking at buying a home right now, again, just quickly, just to go over it, credit. I want to know what's on my credit report. I'm going to pull a credit report. I'm going to look into it. I'm going to see if there's anything on there that's going to be an issue, if anything's fraudulent, making sure that everything's accurate. Also, setting up an account with each of the individual credit bureaus, or at least one of them, so that I'm getting regular alerts when anything is happening to my credit. So if there's ever a situation where something's put on there, I can address it in a prompt, timely manner. The longer things sit on your credit, the more damage it does, and the less likely you are to recognize and know what it is. So get a handle on your credit, sign up with the credit bureaus, get those alerts. Work history, be consistent. The best well-qualified borrowers have good work history. They can show that I've been at the same job for a long time, I've been in the same industry for a long time. The likelihood of me being able to be employed and continue in the future is great, depending on that work history. So have good work history. You know, life happens. I'm not recommending that you do this, but if I was thinking about switching jobs and also buying a home in the near future, I might hold off on making that job switch until I've secured the home. I don't want to shake things up too much to where the underwriter is going to question, well, you know, you were a loan officer last week, but now you're a food truck driver. That's going to be an issue. So just think about that. Be mindful about the fact that your work history is really important when it comes to a home loan. And if you can establish a good work history, that's going to look really good on your application. Rental history, again, maintain a good rental history. Make sure you're always paying on time. Make sure that you are recording everything so that if there is an issue, you can go back to your records and prove that you have been paying your rent on time. And if you are renting from a friend or a family member, you're going to need those records anyways, because a verification of rent coming from a parent does not hold the same weight as a verification of rent coming from a property manager. Okay? Then you need some reserves, some savings, anything that you can come up with. I'm not saying that you have to have a pile of cash, but if you have some that you can put towards closing costs and any costs associated with the loan, also anything that you have in savings, like an emergency fund, they would show that even if you lost your job, you could pay your mortgage for a couple of months, so there's no issues there. And then finally, just know your options. Get out there, ask questions. Feel free to reach out to me if you have any questions as well. I'm always up and available for a conversation. Just know your different lending options. So that's it. That is all I had for today. Again, my name is Drew Smith. I'm a licensed loan officer. If you've got some questions, feel free to message me directly. My information is on my page. Easy to get a hold of. I'll just quickly put in my number here. So again, my name is Drew Smith, and I'll just pop in my number. If you want to contact me directly, you can feel free to reach out, 719-507-1223. And it's Drew Smith. So it's my first initials, D-S. MHS lending.com. So it's D Smith at MHSlending.com. Feel free to reach out to me. I'm always available for a conversation. And be sure to check back in. I'm going live a lot now to answer any questions that you might have.